Hello. Good afternoon, good morning, wherever you're watching us from. I'm Lawrence Spear from the OECD's Public Affairs and Communications Directorate, and I'd like to welcome you to today's webcast, the first webcast of 2015 on the OECD G20 Base Erosion Profit Shifting Project. We have the usual panel with us today from the OECD's Center for Tax Policy Administration. We're going to give you a very quick update on progress in the last few months and even the last few days, I should say, based on the G20 meeting in Istanbul earlier this week. Afterwards, we're going to move very quickly into the current work, the discussion drafts that are underway, and then the next steps. Before I turn the panel over to the first speaker, I'd like to just say that you can join the discussion, as has been the case of all of our other webcasts. Please, as you see the information right there, you can enter questions directly, those that are provided. We'll try to answer as many as we can at the end of the webcast. You can also send your questions by email and join in via Twitter using hashtag BEPS. Right now I'm going to turn the floor over immediately to Pascal Saint-Amand, the Director of the Center for Tax Policy Administration. Pascal is going to talk a little bit about where we are in terms of progress to the G20, and then we'll move into the actual deliverables. Pascal.
Thank you, Larry. Good morning, afternoon, evening to you all. Very happy to be back to you with an update on the BEPS project. There has been some significant progress made since we last talked, which I think was at the end of 2014. We have issued a number of discussion drafts. We have made progress in implementing the 2014 deliverables, and we have presented that to the first meeting of the G20 finance ministers in Istanbul, first meeting of the year under the Turkish presidency. It took place on Monday and Tuesday. I'm just back from Istanbul and happy to share with you the views of the ministers and the support that they expressed to this project. So if we look at what we have reported to the finance ministers, you can see that there are three main deliverables, which are about the implementation of the 2014 agreements. Because, of course, for the 2015 deliverables, we'll be waiting for September, October to be able to present the final outputs. However, as promised in 2014, we have developed the implementation package for the country-by-country reporting and the TP documentation. We have proposed a mandate for the development of a multilateral convention to streamline the implementation of the tax treaty-related BEPS measures. And the Committee on Fiscal Affairs adopted such a mandate, which now has been endorsed by the G20 finance ministers. And finally, we have made significant progress on the patent boxes. You will remember that there was an agreement on the so-called nexus approach, that this agreement was firmed by the G20 leaders in Brisbane. There were a couple of countries missing. They have joined the consensus, and then we have a way forward. Arim will explain to us what's next in this area. You can see on the slide the text of the communique. You cannot see the text of the annexes, but you will see that in the annex to the communique, there are many mandates given to the OECD to develop toolkits with the IMED, the World Bank, and the UN for developing countries, to do work on comparables, and to do some other work on transparency and exchange of information, which are not the purpose of today's webcast. But for those of you who are interested, please pay attention to the annex. For the main communique, as you can see, there is strong support reiterated for the BEPS action plan on the one hand. They welcome the mandate for the multilateral convention. This is unprecedented, this is new, this is, we hope, big in the future, even though it's limited to streamlining the implementation of the BEPS action plan for it to take 2 years instead of taking 2 decades. But you can also see in the communique the work on transparency, which is recognized, the progress which have been made there, and finally, and importantly, the fact that the G20 reaffirms the need for the involvement of developing countries in the development of the BEPS measures. This is something we have reflected upon. We have changed the dynamic of the Committee on Fiscal Affairs to involve more developing countries, and we'll come back to that in a few minutes. So, good report to the G20, very good communique, and I can tell you, as I was in the room of the finance ministers when they talked about that, a 1-hour session dedicated to international tax. Most of the ministers, if not all of them, have expressed great satisfaction with the progress made. They have recognized that there is strong consensus on these measures, which I think gives a lot of strength to this package of measures, but also to the delegates to further agree the 8 deliverables for 2015.
Thank you very much, Pascal. Right away, we're just going to jump in some more detailed information on these 3 different items that were presented to the G20 and endorsed and welcomed by the G20. First of all, we'll turn to Marlies de Ruyter, who's the head of Tax Treaty, Transfer Pricing and Financial Transactions Division, who will talk at greater length now about the country-by-country and TP documentation implementation guidance. Marlies?
Thank you very much, Larry, and also from my side, welcome to you all. I will take you through kind of the release on country-by-country reporting mainly, but also something about transfer pricing documentation. But first, I would like to take you back to what we decided in September. In September, new transfer pricing guidance was published on transfer pricing documentations, and it was also endorsed by the full G20, both finance ministers and the leaders. And this guidance indicates that transfer pricing documentation contains a 3-pronged approach. It consists of a master file containing standardized background information in relation to the M&E group as a whole. It relates to a country-by-country report, which contains specific information relating to the global allocation of income of the M&E, taxes paid, and certain indicators of economic activities per geographic location, for example, the number of employees. And finally, it consists of a local file which is dedicated to the transactions in which the local subsidiaries or PEs are involved. So with that, it gives a full package of transfer pricing documentation, each step very relevant. At that time, in September, it was already indicated that it was essential that these recommendations would be implemented consistently and effectively, because otherwise it would become probably a lot of a burden for business, but also it would not serve the means for which it was intended. So therefore we published implementation guidance, and that's exactly what we published in September in the explanatory note. And this guidance relates to 4 issues. The first is on the timing of the preparation and the filing of the country-by-country report. The second question answered is which M&E groups are covered by the country-by-country reporting. And the third question answered is about the conditions underpinning the use of country-by-country reports. And this all leads into the implementation being done through a government-to-government mechanism for automatic exchange of the country-by-country reports, and that package will be developed by April 2015. What is also indicated is that the master file and the local file will be filed locally, so it will be filed in the subsidiary country where the activities are taking place. But there is agreement between countries that the annexes, the templates that we have produced need to be taken into account to make sure that these kind of templates are used in a consistent basis and with confidentiality. So if we then go into, I'm going to go back. So if we're then going into the 3 questions that are answered, the first being timing. So what does the draft say? It says, first of all, that businesses, multinational groups, do not need to worry about preparing the country-by-country filing before the 1st of January 2016. Because we don't expect multinational groups to start kind of collecting the information before then. That's a commitment by the countries involved. So that would be the first year of preparations, all fiscal years starting the 1st of January 2016. And then what would that mean for when the country-by-country reports would be ready for filing. So the fiscal year, if it starts the 1st of January, it ends at the end of December, and then multinational groups would get 12 months to prepare the country-by-country report, making it available as of the 31st of December 2017. So that would be kind of the time frame in which countries could ask for the information. However, it's also recognized that it is, of course, dependent on the legislation being available in the countries, whether actual requests for the information will be made by the specific countries. The second question answered is which M&E groups are covered by the country-by-country reporting. And here a very important decision was made. I think the key to that decision was that all countries recognized that we needed to gain experience, be as efficient and effective as possible, and not to try to take too big a bite out of the apple. So we agreed that the filing would have to take place for multinational groups with a consolidated group revenue of more than 750 million euros, or a near equivalent amount of that. And that would mean that 85% of the M&Es would be excluded, but nevertheless 90% of world group revenue would be covered. And then there are conditions. Conditions are confidentiality, consistency, and the use of the information, so that the information would be used for high-level risk assessment purposes only. So what would the mechanism look like? It would be an automatic exchange mechanism, and the filing would take place in the country of the ultimate parent company. The exchange would take place based on competent authority agreements that would be developed based on existing legal instruments such as TIAs, bilateral treaties, and the Multilateral Convention. And then it is recognized that sometimes it may not work. For example, when in the ultimate parent jurisdiction there is no legislation to get in the country-by-country report. In that situation, secondary mechanisms may be triggered to get the information in. And finally, it was agreed that there will be a monitoring mechanism of the country-by-country reporting, and that the outcomes of that monitoring will be taken into account in the review in 2020. So that is what is in the recent guidance, and as said, the complete package will be finalized in April 2015. Back to you, Larry.
Thanks very much, Marlies. I'm going to turn the floor over now to Achim Gross, the head of the International Cooperation and Tax Administration Division, who's going to walk us through the harmful tax practices updates. Achim?
Thank you, Larry, and also welcome from me to everybody who's listening to this. Thank you, everybody. Thank you, Larry, and a welcome to everybody who's listening to this. We have now luckily pressed the button so you can actually hear me, which helps. I think, as Pascal already said, the harmful tax practice was another piece of the action plan where we provided information on an agreement to the G20. And as Pascal also said, there had already been an earlier discussion of the work on patent boxes, IP regimes, in connection with the previous G20 discussions. So let me just refresh briefly what this action item is about and then focus really on what's new here. So we had committed by September 2014 to revamp the work on harmful tax practices to require substantial activities. We have a separate work stream that goes to the automatic or spontaneous, compulsory, if you wish, exchange of rulings and a review of member countries and associate countries regimes. So that's all the OECD and the G20 countries. We then have to agree a strategy to go beyond the G20 and the OECD countries, and finally to revise or consider the revisions of the criteria that underpin the work. So if we then look at the current focus, and that's very much to the point here, we have two things that we're focusing on. One is the question of what is the substantial activities factor that needs to be applied to all preferential regimes, and second, how do we apply and implement the transparency criteria especially with respect to rulings and the automatic or spontaneous, mandatory, if you wish, that seems to be semantics, to the rulings exchange. And so if we then go to the point that is an issue right here, and that was reported to the G20, it is about the patent boxes. If you recall, and we've said that in the previous updates, in the report that we did in 2014, we had a significant majority of countries favoring a particular approach, but we did not have a consensus yet. This was followed by a joint proposal by Germany and the UK to bridge those difficulties. That has been further worked, and we now have an agreement on the nexus approach, the revised nexus approach, but importantly the agreed nexus approach by all OECD and all G20 countries. And the text of this agreement was released on February 6, 2015, as you can see here. Importantly also, that is the same approach that is used in the parallel work in the EU, so we have consistency across the OECD, the G20 countries, and the EU process. Now, what does that mean? The nexus approach, a brief recap, it requires a nexus between qualifying expenditures incurred by the taxpayer and the income receiving the benefits. In a simple message, the more investment into jobs and expenses incurred by the entity, the larger the amount that can benefit from a preferential rate. That's how we link substance and taxation back together. It's a proportionate approach. So it's in proportion to the qualifying R&D that the income benefits. And so now finally, what are, if you wish, the changes we have made following from the joint proposal by the UK and Germany? There is one, a 30% uplift, i.e. there's a slightly larger amount that can benefit from these regimes. And then there's two timelines. One is June 30 to 16. That is when we have agreed that existing IP regimes that do not conform to this approach will need to be closed to new entrants. And second, a grandfathering period of those that stay in, the benefits must be phased out no later than the 30th of June 2012. If we look forward, what do we need to do in this area? There's three things that we need to work on. We've committed to do those over the next 6 months. One, we need to work out the details of tracking and tracing, because the nexus approach requires a link between income and expenditure, and we got to do this in a way that achieves the policy objectives, but at the same time is not overly burdensome to business. And so we are inviting comments on this point, and you can submit comments, and we've done this in the public release where you will find where you can submit those comments. The second point is to have additional safeguards. We do not want to encourage, if you wish, IP regime shopping, so that people move into a regime now, a pre-existing regime, simply for the benefit of getting the grandfathering. And finally, we need further guidance on the definition of qualifying IP. We know patents are in, we know marketing intangibles are out, but there is a functionally equivalent space in the middle where we will be developing further guidance. All of this in the next 6 months. And of course, we also need to apply the substantial activities factor outside the area of IP regimes. The second point is the transparency piece. This, as I said, is about the exchange of rulings, where we will be considering the exact scope of the exchange of rulings. A lot of interest in unilateral APAs, conduit rulings, informal capital, a whole host of rulings that want to be exchanged. We also look at whether rulings regimes themselves can be problematic and not just the exchange about the rulings given. And finally, there's an aspect on best practices in respect of rulings. And then I think that's the last slide, and that's also how I think I will conclude here. There's, of course, an ongoing process on the review of the regimes. We're also separately looking into the strategy of going beyond the OECD and the G20 countries. We are considering revisions of the existing criteria, all of which will then be included in the 2015 report that we have committed to deliver. And with that, I give it back to you, Larry. Thanks.
Thank you, Achim. Moving right along through the presentation to the G20, I'm going to give the floor now to Rafael Russo, the head of the BEPS Project, who will explain the next steps in the mandate for a multilateral instrument. Rafa.
Thank you, Larry, and hello, everyone. As Pascal mentioned a few minutes ago, we have an agreed mandate for the development of a multilateral instrument. In September 2014, the OECD BEPS, the OECD G20 BEPS project sent the report to the G20 finance ministers and leaders regarding the feasibility of using such an instrument to modify bilateral tax treaties, concluding that it was indeed feasible and also desirable to do so, with the expectation that a fully fledged mandate will be developed by January 2015, and as promised, the mandate was developed, agreed by the countries participating in the BEPS project, and then endorsed, as you have heard, by the finance ministers of the G20. What is the scope of the work? Well, the scope is limited to the modification of existing bilateral tax treaties in order to implement the tax treaty-related measures which are developed in the course of the BEPS project. And as the work is ongoing at the moment, the expectation is that the ones that you see on the slides will be the candidates to make it into the multilateral instrument. So as a result of Action 2, a provision on hybrid entities, as a result of Action 6, provisions to prevent treaty abuse, LOBs and principal purpose tests, but also a number of more specific provisions to counter certain issues of abuse in the space of double tax treaties. Modifications to the definition of permanent establishment to avoid that PE status is artificially avoided or that the definition is circumvented. Any treaty-related measure as a result of the work on Action 14 on dispute resolution, plus other changes that may be needed, for example, in relation to special measures that may be considered as going beyond the arm's length principle and for which it would be important to clarify the relationship with double tax treaties. In terms of who and when is the work going to be carried out? The work is going to be carried out by an ad hoc, non-permanent group which is convened under the aegis of the OECD and of the G20. This group will be open to all interested states that will participate on an equal footing in the development of the multilateral instrument. At the same time, jurisdictions, but also regional and international tax organizations will be able to join the discussion as observers so as to ensure maximum transparency. And the expectation is that the work will be finalized so that the instrument can then be opened for signature and once ratified, therefore amend pairs of bilateral tax treaties by the end of 2016. The aim, as Pascal mentioned before, is basically to reduce the time needed to make sure that the consensus measures that are developed in the course of the project can become effective as soon as possible and amend bilateral tax treaties. Thank you, Larry, and thank you very much to everyone for your attention.
Thanks very much, Rafa. We're going to hand the floor back over to Pascal, who's going to tell us the latest update on the work with developing countries.
Thank you, Larry. Very quickly, as you know about that, I think we presented the strategy at our last meeting. It's a three-pronged strategy. First, involving developing countries in the standard-setting body, which is the Committee on Fiscal Affairs. We have more than 12 countries which have joined the CFA, the Committee on Fiscal Affairs, and even more countries joining the different working parties, in addition to the existing observers to the Committee on Fiscal Affairs like Malaysia, Singapore, and some others. The second part of the strategy is about involving even more developing countries because they do not all have the capacities to come to the Committee on Fiscal Affairs. And we just selected those who had the capacities and who expressed interest in doing so. For the others, we will be holding regional meetings for regional networks with the support of the Regional Tax Administration Forum organizations. And finally, we are involved with the other international organizations, the IMED, the World Bank, the UN, into a capacity building exercise, developing toolkits under the monitoring of the Development Working Group of the G20. So You can see here the list of the regional network meetings that we will be holding, starting with the Asia-Pacific region in Seoul, 12th and 13th February. We then have a meeting in Peru, which is next week or the week after next, where we will have all the Latin American region plus the Caribbean. We'll have a French-speaking countries meeting with CREDAF, qui se tiendra au Gabon le 27 février 2015. We need to pay some tribute to the French language here. And two more, Eurasia in Ankara for all the Central Asia and Central Europe region. And finally, Africa in Pretoria at the end of April with our great partner ATAF. And SIAT, of course, will be participating to the one in Lima. So quite an in-depth engagement of developing countries.
Thanks very much, Pascal. We are about halfway through the webcast, and that's fitting as we're also halfway through the BEPS deliverables. We're now going to move on to talk about where we are this year in the 2015 package. And I'm first going to give the floor to Rafael Russo, who will give us a quick update on where we stand with the discussion drafts.
Thank you, Larry, again. Here you see on this slide a table which basically provides an overview of all the different discussion drafts that we have issued in the past few months. Some of them we discussed, we presented them at the last webcast in December, in particular the one on Action 7 regarding permanent establishment, Action 10 regarding low value adding services, the follow-up work on Action 6 regarding prevention of treaty abuse, and the one on interest deduction and other financial payments. Therefore, what we would like to do today is to focus and spend enough time on the discussion draft on transfer pricing, in particular the one on risk and recharacterization, and then talk also about the VAT business-to-consumer guidelines for which a discussion draft was issued before December. And as you may remember, this is the work that is part of the wider work being carried out in the context of the broader challenges raised by the digital economy. And finally, a few words about Action 14 regarding dispute resolution and the feedback that we received from you on those.
Thanks very much, Rafa. We're going to turn the floor immediately over to Marlies to talk to us about risk and recharacterization, please.
Thank you very much, Larry. Yes. So my contribution on transfer pricing is going to be dedicated only to risk and recharacterization and the changes to Chapter 1. And the aims of that kind of work stream was to ensure that inappropriate returns will not accrue to an entity solely because it has contractually assumed risks or has provided capital. And besides that, we were asked to clarify the circumstances in which transactions could be recharacterized because there was uncertainty surrounding that. And in order to do that, we drafted a discussion draft in two parts. The first part relating to Chapter 1, to the risk and recharacterization part. And there is a revision to Section D of Chapter 1, including new wording on the functional analysis and risk and non-recognition. And non-recognition then is the new wording used for recharacterization. In Part 2, we have discussed some options for special measures, and I will go into it later when these special measures will apply. So what are these proposals aiming at? These proposals aim to look at the potential for misalignment of profits and value creation. And that may arise because of a misalignment of form and substance. And in particular, that may follow from an exclusive reliance on mere contractual ownership, mere contractual assumption of risk, and provision of capital. So we looked at how can we align the factual substance with the contractual reality. And in order to do that, we set up the following analytical framework. The key first step of any transfer pricing analysis should be to accurately delineate the actual transaction undertaken. Before you start the exercise of pricing a transaction, you should know what transaction you're pricing and in what circumstances that transaction takes place. And then the second step of that analysis is to price this accurately delineated transaction by finding comparable transactions and choosing a transfer pricing method. And it was our experience that often these two steps were not as separated as they should be. So you define what you need to price exactly, and then you price. That's the core message. And then the question is, and how is then the actual transaction delineated? And when you delineate this transaction, you have to look at the written contracts. But you also have to carefully assess the conduct of the parties in the context of their commercial and financial relations. Besides looking at what's on paper, you have to look at the business reality, the way that these parties interact, and the way the transaction has taken place. And then if the conduct of the parties contradicts or supplements the written contracts, the conduct of the parties is used to supplement or to change the contractual relations if needed. And I want to give a simple but very extreme example. Suppose you have a parent company and a subsidiary, and the subsidiary is a manufacturing entity, and the parent company provides IT services to this subsidiary. Only there's no contract. It does provide it, it shows from the conduct, but there's nothing on paper. In that situation, you will, of course, not say, I don't have a paper, so there's nothing to price. You will look at what's happening in practice, you will delineate the transaction that has taken place, and then you will price that transaction. So that is what is meant with delineating the actual transaction undertaken. And when making that functional analysis and when delineating the actual transaction, it was clear that there was very limited guidance on risk. Only a couple of paragraphs were dedicated to risks in Chapter 1. Well, the whole sense and the whole core element of doing business is assuming risks and making sure that you get the prime returns that relate to doing business and assuming risks. So what we are saying is that risks should be identified with specificity. You should look very carefully what risks are being assumed. And then you should look at the role of these risks in the business environment. How are these risks assumed? How are they managed? What kind of risk mitigation strategies are in place? And what would happen if they play out? What is the risk? What is the impact if they materialize? And then the final step is that it needs to be assured that valuable risk management activities are rewarded appropriately and that the risk can only be allocated to a party that actually controls the risk. So that it cannot be allocated to a party that is the mere contractual owner. There needs to be a form of control over the risk in order to be able to be attributed the risk. So I think that's more or less what the guidance is doing. And maybe Pascal would like to say something about that.
Thank you, Marlies. Just to reinforce what you've just said, because we understand that there has been misunderstanding, and when you read different pieces here and there in terms of comments, it looks like some have clearly misunderstood the attempt done by the draft. The key messages, as highlighted by Marlies, are: one, what we want to do is to price the business reality and not the paper reality. And this is extremely important. Why doing so? Because transfer pricing are about pricing. But what do you price? Well, you price what is effectively happening. And this, we think, will actually flex the muscles of the arm's length principle to work it harder, because we want it to live a healthy life and a long life. Not that we believe in any God, but it's just pragmatic. It's working. It has deficiencies. We want to fix the deficiencies by allowing the transfer pricing guidelines to facilitate the pricing of business reality. There is agreement let's be clear about that, by all the members of the Committee on Fiscal Affairs, together with the BEPS associates, which are these 10 non-OECD countries which are in the G20 or which are in accession mode to the OECD. There is agreement, even though here and there, in the draft, there are options which are left open, or that there are areas where we don't yet reach consensus. And the reason why we have issued this discussion draft at this point in time before all consensus is reached on all actions is precisely to show the sense of direction, to get your comments. And we were not disappointed by the amount of comments that we have received. And we do recognize that transfer pricing is not rocket science, it's not an exact science, and that there may be differences of views, differences of implementation, that we need to work out to reduce the risk of double taxation, which is real in this area. And that makes a link to Action 14 on the dispute resolution mechanisms we'll go back to in a few minutes. So the key message here is this is an attempt to fix the deficiencies of the arm's length principle, to remain within the arm's length principle by delineating the real transaction. With the support of the contract, we are not disregarding the contract, we are just looking at the business reality. But for sure, Marlies will give you more hints with what she's going to say about risk.
Thank you very much, Pascal. And you know, it's clear that the idea is that the arm's length principle will be lean and fit after this exercise. And I wish the same can be said about us when we finish the BEPS project. So I think one thing that would be worthwhile to go into is that, so if we make the arm's length principle work harder, are we actually changing the arm's length principle? Because that's a suggestion that has been made by practitioners. And it has been suggested, for example, that outsourcing of routine activities would no longer be possible, because the only thing that would be relevant would be people functions, and kind of contractual allocation of risk would be disregarded, and also capital would be disregarded. And I would like to show that that is not the case. We are kind of totally aware that it's about assets, functions, and risks, and we need to look at all the three prongs. And I would like to illustrate that by identifying what control over risk is. So what do you need to do to be able to get the allocation of risk? You need to have the capability to make decisions to take on the risk. And you need to have the capability to make decisions on whether and how to manage the risk. And then you don't have to do all the risk management activities yourself. It's very common that you use other parties to mitigate your risk. You can insure it, you can use other risk mitigation strategies, but core is that where a decision is made to outsource risk mitigation, control of the risk would require the capability to assess, monitor and direct the outsourced measures that affect risk outcomes. So you need to stay in control. You need to be able to assess whether the risk mitigation strategy is actually working. And in order to do that, you do not only have to be capable of doing that, you actually have to do it. So it needs to include the actual performance of the decision-making functions and the functions related to assessing, monitoring and directing the outsourced measures. And that's of key importance. So there the bottom line is, of course, outsourcing is still possible, but it needs to be directed by the party in control over the risk. So where does it lead us in relation to non-recognition? I think the first important thing to establish is that delineating the actual transaction is not non-recognition or recharacterization, but it's aligning the form and the substance. And that is a factual substance kind of exercise. And this is what has been agreed between delegates. And when we started this project, there was quite a bit of confusion there. So this has been a real achievement that we could clarify this. So when does non-recognition come in then? That comes in when the transaction has been accurately delineated, where we know what the transaction was, but it doesn't make commercial sense because it doesn't provide each of the parties with the possibility to protect or enhance their commercial or financial relations. And given what we did on delineating the actual transaction, that non-recognition phase will only kick in very exceptional circumstances, is our assessment. So do BEPS risk remain if we do this? And that's a very important question. Of course, it will get us a long way. The new guidance makes the arm's length principle work very hard, but it may not prevent all BEPS risks. And the BEPS risks that remain, they relate to two things. Situations where the arm's length principle does work in practice or in theory, but there may be problems in practice. For example, because of information asymmetries between the taxpayer and the tax administration. And that may be the case, for example, when we're talking about hard-to-value intangibles. The second situation occurs when we're talking about minimum functional entities in low-tax environments that are highly capitalized. Because based on the previous kind of measures that we introduced, the return for those entities may be mitigated to a financial return, but they will still get the financial return. And some of the delegates want it to be brought back to zero. So that's why we're also looking at special measures to take away these information asymmetries, but also to address minimum functional entities. And in doing so, I think we need to recognize that there is a very close interaction with other actions, including the work on Action 3, CFC regimes, but also in relation to Action 4 on interest deductibility. So if you then look at where we are in the process, the deadline for the comments was February 6th. We received about somewhat close to 900 pages of comments. We will have a public consultation in a month on 19th and 20th of March. And then following that, we will release a discussion draft on CCAs, intangibles, and profit splits. And that follows from the work we're doing on risk and recharacterization. And we will have another public consultation on those issues in July 2015, with the aim of finalizing in September 2015. The last slide is an overview slide that gives you an indication what the planning is, just to give you an idea of where we are in relation to the work. And I think one thing I would like to stress is in relation to profit splits. We also received a lot of comments. As you will see, there are 2 discussion drafts scheduled here and 2 public consultation. This draft was meant solely to start up the thinking of the work, to try to get our guidance on profit splits to be more objective and specific. And we will come out with guidance following your contributions after the public consultations and our deliberations on that. So thank you very much for your attention.
Marlies, thank you very much for that marathon presentation there. We're going to jump right in to Pete Bathieu, who's the head of the Consumption Tax Unit, who's going to talk a little bit about the work going on international VAT guidelines. Pete.
Thanks, Larry, and welcome everyone to the wonderful world of VAT for a 100-meter sprint update on the VAT aspect of or one of the VAT aspects of the BEPS action. In December last year, we released discussion drafts of 2 new chapters of the VAT GST guidelines, and these VAT GST guidelines are the emerging global standard that the OECD is developing for the VAT treatment of international trade. Now, the first discussion draft deals with cross-border sales of services and intangibles to private consumers. The second discussion draft dealt with or deals with administrative cooperation, issues of evasion and avoidance, and dispute minimization. Now, this update looks in particular at the first discussion draft, as this draft is directly related to BEPS Action 1 on the tax challenges of the digital economy. Now, as a quick reminder, the BEPS Action 1 report on the digital economy that was released in September last year highlighted the difficulty for countries to collect VAT on sales of digital products by offshore suppliers, non-resident suppliers, particularly when these supplies were made or are made to private consumers. And there was even some uncertainty whether consumer states were actually entitled to collect VAT on those sales, or whether it wasn't rather for the supplier country to collect a tax or even to collect no tax at all. And given the massive growth of the trade in this these type of digital products, the massive growth of B2C trade in digital products, this was considered an issue, a pressing issue that needs to be addressed urgently. Now, what does the discussion draft say? The discussion draft now confirms explicitly that VAT on sales of services and intangibles to private consumers needs to be paid in the jurisdiction where the consumer has its usual residence. And that collection of this VAT is best achieved by requiring the remote supplier to register and remit VAT in the customer's jurisdiction. Now, we realize that this may entail quite a bit of compliance burden, particularly for suppliers that have obligations in multiple jurisdictions. So therefore, we encourage and we recommend jurisdictions to implement a simplified registration and compliance regime for some remote suppliers. And we have developed and promoted, are presenting actually the key features of such a simplified regime. And to summarize things a bit, under this regime, remote suppliers are expected to comply with obligations only to the extent at which this is really necessary to collect and remit the tax. Only the crucial functions need to be completed under such a simplified regime. And we promote as much as possible a regime that is supported by online technology, online processes, website-enabled procedures and processes. Now, finally, jurisdictions will strengthen administrative cooperation in VAT, as well as the exchange of information in VAT to support the effective implementation of these new rules in practice. The 2-month public consultation period is still running. It's due to end next week on Friday, on the 20th February, and a public consultation meeting to discuss these drafts will be held in Paris on the 25th of February 2015. That's all for me. Back to you, Larry.
Thanks very much, Pete. Moving right along, I'm going to ask Pascal to talk a little bit about making dispute resolution mechanisms more effective. Pascal.
Thank you, Larry. I'd be quick, even though there is a lot of work to do there. And you have on the slide the different steps. We issued a discussion draft. We received a number of comments. I can clearly say that the comments were not enthused with the proposal. It reflected a lot of frustration from the commentators, largely the business community, but also some countries. And we will now revise the discussion draft based on the comments. We are fully aware of the shortcomings of the proposal, and this will be strengthened, this will be muscled, this will be increased in terms of reach and in terms of ambition. We are fully aware that there is no way to move from double non-taxation to double taxation, which is detrimental to growth, which is detrimental to investment, which is detrimental at the end of the day of the business environment. And we need to address that. The countries have always been a bit reluctant and very often hiding behind sovereignty not to do their jobs, and they recognize that. Now, there are divergences on where to go. Arbitration clearly doesn't meet consensus. A number of countries do not want to go there, but a number of countries want to go there. So what we will be doing, and you know about the three-pronged approach, you know about the stringent peer review mechanism which has been proposed, which has started with the firm on tax administration, which will be developed, which will be strengthened so that we can report to the G20 using the leverage of the political attention of the G20 to make sure that we make big progress there. We will use a range of options, including arbitration, with probably a number of like-minded countries willing to lead by example there. And what I can report is that at the last Committee on Fiscal Affairs, which was 2 or 3 weeks ago, all the countries finally took a positive stance on this issue, saying, yes, we need to make progress. all of them, the whole range of countries, recognizing the differences, but recognizing that there is a common goal. We need to improve the effectiveness and the efficiency of dispute resolution mechanisms. We will be doing that. We've listened to you, and we will be back to you quite soon with a number of proposals. So this is what I wanted to clarify at this point in time on this front.
Thanks very much, Pascal. Thanks to all the presenters. You've walked us through a large part of the ongoing work, but there still are some additional steps coming. And Rafa, head of the BEPS project, why don't you walk us through that quite quickly, what's coming up?
Yes, and I'll be quick because we have received a number of questions which we would like to answer. A number of discussion drafts are coming out soon on Action 11, Data and Economic Analysis, Action 12, Mandatory Disclosure Rules, Action 3, CFC Rules, and the one on transfer pricing that Marlies mentioned. We will also have a number of public consultations. The next one is on interest deductibility on the 17th of February. Pete mentioned the one on VAT. We will have the consultation on the discussion draft on risk and recharacterization on the 19th and 20th of March, and then a public consultation on Action 11. Please note there is a typo on the slide. It's not the 27th of March, it's the 13th of May, and we will post the right slides on the website soon. Thank you very much.
Thanks very much, Rafa. I'd just like to point out we have run through the material that was prepared for presenting to you today. And thanks to all the presenters again for the work on that. We're going to go into the questions now, but before we do that, please, anything you'd like to say to the presenters now, you can enter your questions directly in the space provided. Even if we don't have time to get to them today, we will see them. Send email to the address there. Interact with us via Twitter using hashtag BEPS. I'm going to go right into the questions now that we've received. The first one I see here, I believe, is for you, Achim. What kind of rulings won't be covered by automatic exchange?
Thank you for a question. Excellent question. I think, and I've said this in the last update, I think where we try to get to here is to give tax administrations the information that they need, but not to flood tax administrations with a lot of stuff, paper that they couldn't possibly process. That would be the most ineffective. It'd be effectively hiding the one thing that you needed in a whole volume of data. So what we're talking about, and I cannot say what the final outcome is, because as I said, this is an ongoing discussion that's happening as we speak. It is those rulings that create BEPS concerns. It's those with a cross-border aspect. There's, I guess, three dimensions. Defining the types of rulings that would be covered by the exchange discipline. Second, defining to which country that goes, because even if it's covered, it doesn't mean it needs to go to all countries. And then also thinking through whether there's differences for rulings that will be given in the future, as opposed to rulings that have already been given, but that still apply today and are, because of their continued application, relevant for the other countries. What I've said is I think the types of rulings where there's strong interest range from informal capital rulings, unilateral APAs, conduit-type rulings, whether in a narrow and a broader sense, more in an economic sense. That's certainly where a clear focus of the attention is. We have to work out the details further. We will do that. We will get that done in time for the 215 outcome. And we're very conscious of the fact that we need to get that balance right of not over-flooding tax administration and stay focused in what we do.
Thanks very much, Achim. I'm going to move a question right away for you, Marlies, on documentation, on transfer pricing documentation. Is there guidance as to when multinational enterprises are required to prepare the master file, the local file, and is it the same implementation timeline as for the country-by-country reporting?
Thank you, Larry. I think that on the timeline of local legislation, we left that more to the countries involved. In some areas, there are already global files applicable, for example, in the EU. And definitely all countries already have local filing requirements. So updating those is more up to the pace of the countries that want to introduce it. And given the importance of the coordinated approach in relation to country by country, we thought it would be important to be more forceful there.
Thanks very much. There's another question on country by country, which won't surprise you given the amount of comments we've had on that topic. Maybe for Pascal, in fact. There's clearly still some nervousness among taxpayers about the confidentiality of country by country reports. Is there anything you can say now or do that will reassure taxpayers that they'll only be seen by officials that are meant to see them? Pascal?
Thanks, Larry. Well, I would recommend them to read the piece which has been issued and reported to the G20 finance ministers, which reflects full consensus among the countries which participate in the BEPS project. There is no single, not any difference between the members of this project. And this clearly states that country by country reporting information will be collected by the headquarter country, will be exchanged through exchange of information treaties or mechanisms like the Multilateral Convention on Mutual Assistance, so through Ts, which all protect the confidentiality of the information, which is being reviewed by the Global Forum on Transparency and Exchange of Information, and this is currently being strengthened by the move towards automatic exchange of information. So we are not on uncharted territories. We're on something which is extremely well known, extremely well checked, so that the information be protected seriously. And that's the agreement of the countries. There are just a few exceptions to that, which are not exceptions to the confidentiality of the information. The exceptions to the country-by-country reporting through government-to-government mechanisms, through tax treaties, are where a country will not ask its companies headquartered in this country to report anything. In that case, the other countries need to protect themselves, and in that case, it is recognized as legitimate that you have local filing. But local filing doesn't mean that the information goes public. It will be protected because all the countries which have committed to this project say we need to protect the confidentiality of the information. So I don't know what more we can do to reassure the people, maybe taking some pills or relaxing. It's not to go public. That's what the governments intend, and that's what they have clearly said and committed to. There is no ambiguity, so just relax there. Not a single country has in mind that this information should leak or that this information should go public, because I think all the countries understand that it's a cooperative game. Local filing is really exceptional because it may not be as efficient as exchange of information. You need the quality check by the headquarter country, the headquarter country of the company. And that's why all the countries need that cooperation. And they know that if it goes public, they will lose it. So I think there is a joint interest there, convergent interest between all the countries, which will result in securing the confidentiality of the information.
Thanks very much, Pascal. We've also had quite a number of questions on the multilateral instrument, and I think we could maybe jump through a couple of those really quickly. First of all, which countries can participate in the work on the multilateral instrument? And maybe at the same time, do you require a 100% agreement? Do you need full consensus? How much agreement is required to see this instrument through? Pascal, do you want to maybe answer that?
Thank you, Larry. That's a good question. What has been agreed is a mandate where all interested states will be able to join. That's not the case for the jurisdictions, which do not have a state status from an international public law perspective, but all interested states will be able to participate to the negotiation of the multilateral instrument, noting, however, that this should reflect the agreement on the tax treaty-related BEPS measures. So the substance should be developed within the context of the BEPS project. So all the countries are invited to participate. Then they will be free to sign or not to sign, and if they sign, they will be expected to ratify. There is another question to that, which is, well, will there be some form of flexibility? I can buy in a few measures and not a few others. We tend to think at this point in time that there should be some flexibility while not too much flexibility so that we don't miss the goal, we don't miss the objective. I can give you an example. On dispute resolution, would it make sense to include compulsory arbitration in this draft? Yes, probably, but if there is no flexibility for the countries which definitely do not want to move there, we may lose them completely on this, which may not be to the benefit of anyone. So this is precisely what the group will be discussing, will be negotiating, and where there is agreement on this, the countries will decide whether they move forward or not.
Thanks very much, Pascal. Another question that is that's linked in a way to who's participating in the multilateral instrument is the question of developing countries in BEPS. We've had a couple of questions about that in the work we're doing here at the OECD. How did we select the countries, the developing countries that are now participating, and how did that process take place? Maybe you can walk people through that as well, Pascal.
Thank you, Larry. As I explained earlier during the webcast, we are in touch with all the countries, and they are actually willing to join the different global fora that we have. We will be holding soon a global forum on transfer pricing where we have more than 100 countries present. And they are rushing to come, and we're extremely happy with this very good relationship. So we know them, they know us, and those which express an interest, of course, have been selected by definition. But some others we've approached, and given their level of capacities and their ability to join, we have welcomed them in the process. Those which cannot afford that because they don't have as many experts as they wish they had, we will be reaching them through the regional network. So it has been quite pragmatic, and I think it reflects the strong interest from a number of developing countries to join, which have the capacities, which will be able to provide inputs. And we have hired 3 people, actually, just to take care of them, so that they can phrase their comments in a way which is useful to the process, which can be inputted in the process, whether it goes in the sense of direction which has been agreed or not. Because precisely the purpose of this exercise is to reflect the views of the developing countries, whether they are in line with the sense of direction or not. And these people will make sure that the developing countries understand this mechanism, which is extremely complex, which goes extremely fast, so they need support, and they will get the support from us, as well as from the other international organizations which are engaged in what we call a structured dialogue with the developing countries. So I think the resource is spent there. The need to address developing countries' needs and specificities is well recognized, and we're working hard on this critical aspect.
Pascal, thank you very much. I'd like to thank all the panelists. We've reached the end of the webcast now. We will be in touch about future interactions as the work goes on, as you've heard it is. Please, you see the contact data there. You can find all the information, this webcast, the slides, all the work that's being done on BEPS, the discussion drafts at the website, oecd.org. Tax BEPS. Please contact us at the email you find there. Sign up for email alerts, and thank you very much for continuing to participate in the process.